Hi, I'm James Leong. I'm the founder and master trainer of Visions One Consulting. I'm an adjunct professor with National University of Singapore. I train for a lot of clients. Let me show you some of them. Now, I'm very committed to helping to raise the level of financial mastery of people so that businesses and organizations can succeed in building a world of abundance. In my 20 years of training, I come across a lot of people who struggle to understand financial statements. So today, I'm going to show you an easy way to understand how financial statements are created and what do they tell you about the business. But before I do that, let me tell you something about one of the participants in my workshop, and his name is Alan. Alan runs a very successful business. He has a product that can help a lot of people. But as his business grows, Alan gets more and more stressed. Why is that so? Because now he has to do budgeting. He has to look at financial statements. He has got to look at numbers and make decisions based on those. Well, you see, Alan comes from a non-finance background. So all this finance stuff is alien to him. When he looks at financial statements, he has no clue what he's supposed to be looking at. When he's sitting down with his bankers and his investors, he often got lost in financial jargon and terms. So he had a realization he needs to get himself up to speed. Alan knows for a long time that finance is his weakness. He tried Googling, he tried to read books, but he could not get them, he could not understand, he get even more confused. He even tried attending a finance workshop, but it turned out to be very dry and boring. So he didn't learn as much as he wanted to, and in the end he could not apply what he was taught. So he brought up his problem to his friends, who gave him a recommendation to come and attend my training. So let me share with you a little about what Alan has learned in my training today. We're going to call this session Financial Storytelling, which is about telling actionable stories from the numbers so that it can drive your business performance. So specifically, we'll learn to take away three things. First, make sense of financial statements, understand the stories they tell you about a business. Secondly, learn about how investors and bankers will assess a company. And thirdly, look at how wealth is being created in the company and how you can grow it. Are you ready for your learning? Great, let's begin. So for our learning today, I will be using the whiteboard and I'll be drawing pictures. Why pictures? Because it's going to help you to visualize the concepts easily, and it's going to make things more memorable for you, and you can see very dynamically how the concepts are being brought to life. So let's begin with a story. Suppose that you want to buy something, a property. Say the property costs $100,000. Now you look into your bank account and this is what you find. $80,000. Are you able to buy the property? Well, no, if you rely just on your own money because you only have 80, but yes, if you use other people's money. So if you borrowed 20,000 plus the 80,000 that you have, you will have 100,000 to buy the property of 100,000. Now, let me share with you how this story will be told from an accountant's perspective. Accountants are often associated with a particular shape. People often say that accountants are very square. So I'm going to tell you exactly the same story from an accountant's perspective using a square or a box. So what I've just said is that you bought A, which represents an asset, 100,000. Now how did you pay for the asset? Remember, you borrowed 20,000. We're going to call it L, which stands for a liability, because whatever money that you borrow, you need to repay. So the loan is a liability. Now, AT comes from your own money, and the accountant calls it E, which stands for equity. So 80 plus 20 will allow you to buy an asset of 100. So think of assets. Assets is what you own, a liability is what you owe, and equity is owner's contributed capital. When you think about asset, what imagery comes to mind? Think of the pictures that come to mind. Yes, if you're thinking about buildings, you're thinking about machineries, if you're thinking about systems, you're thinking about inventories, those are typical examples of assets. Why would a business want to buy or invest in assets? For one main reason. Assets will help them to create value. By creating value, they're able to sell to their customers, and the customers eventually will then pay them in the form of cash. And hopefully whatever they spend to manufacture or to produce that good or service will cost less than whatever they're receiving from the customer, making a profit. So in short, the primary motivation for a business to buy assets is because of this. Assets create future cash inflow for the business. Now once you understand the purpose of asset, then the liability will be the opposite. Liability will then create future cash outflow for a business because you need to repay the money that you borrow. Now let me simplify this even further. A equals to E plus L. Now it's a very fundamental equation, which essentially is the way I have drawn up in a box, but it tells us something very, very universal, something very fundamental, because it tells us something what is called a funding story of a business. All businesses own assets, and all assets will need to be funded, and there are really just two main sources of funds that a business can tap into. Owner's funds, which is contributed capital from the owner, or borrowed funds, which is your liability. Now as entrepreneurs, business owners, we all want to grow our business. So when we grow our business, naturally we will have more assets. However, to grow our assets, we need to have funding, either getting from owner or getting from the lender. Now, this funding story will tell us something very important, depending on how you fund your business or how you fund your assets. Do you rely more on equity or do you rely more on liability? Now, why does it matter? I want you to think about this and visualize this. Imagine this is a platform. A being the platform, and it is supported by two legs. One leg is called the equity leg, the other leg is called the liability leg. Now, which leg do you think is more stable, equity or liability? Liability is something that you need to pay back in the future. There's going to be a future cash outflow. So in other words, liability is a less stable form of funding for a business. So the more liabilities you have, the more risk that you are taking, because at some point in time, you are going to be paying off your liability, and you subject the business to greater uncertainty. Let's take a look at an example. So we have a very high profile public listed company here in Singapore. It's in the water desalination business. So it bid for a plant, to build a plant, cost them $1 billion. So as part of their growth, they're going to invest $1 billion on a desalination plant that could desalinate water at the same time generate electricity which they could sell. So assets create future cash inflow. So that was part of their growth plan. But because it costs a lot of money, the owners do not have enough share capital. So equity is not sufficient to pay for the asset. So therefore, naturally what they do was to go and borrow more money by raising L. Now, guess what happened? as we said earlier on, the more liabilities you have, the more greater future cash outflow that you have. So unfortunately, after they built the plant, there was a change in the regulations. So the electricity market was deregulated. That means to say that there's more competition coming in, and hence the selling price or whatever they thought they could sell for could not materialize. They have to sell electricity at a lower price. As a result, the future cash inflow from the sale is lower than the committed future cash outflow based on whatever they promised their lenders they're going to repay. And hence, there is a mismatch right now. And as a result, as we all know, the company has gotten into trouble and is on the verge of insolvency because of this. So the lesson here to learn is that as owners, we want to grow our business, but it's also very important to pay attention to how we fund the growth of our business. So the more liabilities we take on, the higher is our risk profile. Let me give you more practical application of this concept. Assuming we have two different businesses over here. The first company on the top, the second company at the bottom. Now, assume that the assets are identical. Now, which company would you consider to be financially stronger and which one financially weaker? Did you guess the first one as stronger? If so, that's the correct answer. So, there's less liabilities compared to equity. So the way we say is, we say this company has a strong, I'm going to introduce another word for you here, balance sheet. Why balance sheet? Because if you take a look at the A, the E and the L, when they add up, they are equal and balanced on both sides. So for a business that has got a lot more equity compared to liabilities, we will say that this business has a strong balance sheet. On the other hand, if the business has more liabilities than equity, we will say that this business has a weak balance sheet. Companies with weak balance sheets are of higher risk, and in the event of a downturn, for example, or a recession, they will likely to be the first to go bankrupt. So the example that we spoke about earlier on about the water desalination company, do you think they have a strong or weak balance sheet? A weak one. So they have a lot more liabilities compared to equity. On the other hand, if you look at a company like Apple, one of the highest valued company in the world, they have a lot more liability, a lot more equity compared to liabilities. In fact, the ratio is like 3:1. So Apple has a very strong balance sheet. So the point here is to note, if you have a weak balance sheet, the banker, how they will assess your business, they will perceive you to be of high risk. And if you go to them for a loan, the chances of them accepting your loan or giving you a loan is a lot lower because they are perceived to be high risk, and if you are perceived to be high risk, then you might go bankrupt and never repay back the loan that you take from them. So the key thing here is that as you build your business, pay attention to your balance sheet strength. You want to build a strong balance sheet. Right? So let me summarize what I've just said. So the first financial statement that we just covered is called the balance sheet. So all balance sheets essentially can be broken down into just three things. They are all made up of assets, liabilities, and equity. And what does the balance sheet tell you in terms of a story? The balance sheet tells you about the funding story. How are you funding your business? More E or more L? So from the composition of whether we have more E or equity funding versus more L, which is liability funding, it can tell whether your business or your balance sheet is strong or weak. That's the first story. Funding story tells you whether you have a strong or weak balance sheet. And the tip for you here is, as you grow your business, pay attention to building a strong balance sheet. So let's review our learning agenda. So what we have covered is we make sense of financial statements, understand the stories that it tells you about a business, and how you could improve your performance, increase your strength, and attract investors and bankers who want to invest in your business. We also learn about how to create wealth using the wealth creation cycle, and overall doing more with less. Less expenses and less equity. That increases your ROE, making it a very attractive business. Now let's go back to Alan. After Alan attended my training, he overcome his fear of financial statements. He knows exactly where to zoom in and look at critical numbers that tell him about his business. And when he engages bankers and investors in financial discussions, he's now able to articulate with confidence using financial terms and jargon. Now, can you imagine what if Alan didn't attend my workshop? Today, he will still be lost. He will be making poor business decisions, and his business potential might not be realized. What about you? Are you still living in fear of numbers? Are you still making suboptimal business decisions because you don't know finance? Now, what if you apply what I just shared with you, the principles and concepts in running your business? Will you be more strategic in your decision making? Will you be better aligned with investors and bankers? And will you be more articulate and present confidently using financial terms and jargon when you do your pitch and your next business presentation? So I'm going to offer you a challenge. For the next 30 days, look through your income statement. Pick a particular expense item and think about how you can reduce by at least 1% that particular expense. Take a look at your P&L, look at your sales, look at one item and think about how you can increase your sales by at least 1%, either selling 1% more or increasing the price by at least 1%, and see what it does to your profit margin and ROE. Can you resonate with Alan's story? I would like to add that today, for people like Alan, to succeed in business, you need to know your numbers. The best entrepreneurs and the best CEO have it. Warren Buffett said, accounting is the language of business. If you want to succeed at business, you need to know the financial value of the business. He also advised that if someone offers you an accounting course, jump on it, because it's going to make your life so much easier for years to come when you read financial statements. And he said that learning finance and accounting is like learning a new language. It takes a bit of study at the start, but it's going to pay you huge dividends in the future. So I'm going to share with you the testimonials of some of my participants who have attended my finance and accounting training.
I attended a 2-day course by James on financial statements. It was very, very useful because James managed to make what would otherwise be a very dry topic come alive with this very fun and interactive way of training and helping you learn. At the end of the course, you're able to capture some very key concepts in a very concise manner, and you'll be able to remember it well because of the way he has delivered the course. So I would strongly recommend anyone to attend this course.
Hello everyone, I'm Emily, and I've just attended a financial course with James. I really appreciate the fact that how he could illustrate accounting and finance in a very artsy format. I mean, me being a linguist in training, I have no number sense. And at the same time, it was really exciting to see how the numbers come to life and how subjective yet factual they can be. So with all the illustrations, the humor, the games, the simple conceptualization, it was very easy for me as an arts and humanities student to relate to the numbers in a very simple 2-day format. Thank you.
My name is Nicholas, and I attended a 2-day course with James. Other than a cool name, I really appreciated today's course. It gave me confidence in dealing with financial statements, which I've never done before formally. Most importantly, after going through so many kinds of training, the training was useful because of the clear methodology used and a very clear idea of how James wanted us to learn, and I definitely benefited from that. And I strongly encourage people, especially people like me who don't have a finance background, to definitely join the course. Thank you.
Are you ready to invest in your personal and business success? To demystify financial statements, improve your business performance, and generate more cash flow for your business? If you are, then be sure to contact me at my email address that follows. When we achieve a higher level of financial mastery, together we can create a world of abundance.